every single global central bank except the Fed is accumulating gold. If anything, and I'm not joking, the smart move would be to lean into Basel III compliance and start backing the dollar with gold. It's not such a crazy idea if you're caught naked short using unfunded government liabilities into a global short squeeze. If anyone could force a US Treasury gold price revaluation, it would be Trump. And then after that, what use would the Fed be is the next question. Let's see what Judy Shelton gets up to in January, shall we? Now, the only question remaining though is what percentage of your rapidly debasing, depreciating dollars, pounds, euros, yens have you protected with zero counterparty risk, physical gold and silver?
AndrewMaguire highlights a growing trend among central banks, particularly in the global south, to reduce reliance on US dollars and Treasury bonds in favor of gold. This steady accumulation, exemplified by China's continued gold purchases, reflects a broader move toward de-dollarization within emerging economies and beyond. BRICS Plus, which now controls 42% of global central bank foreign exchange FX reserves, is at the forefront of this shift. While the bloc's active gold buying positions the asset as a viable alternative to the US dollar, gold still comprises only 10% of their central bank reserves, half the global average. This indicates significant room for growth in gold-backed reserves among BRICS Plus nations. However, prospects for a widespread pivot to BRICS Plus currencies, or even a synthetic alternative, remain limited by member countries' modest external liabilities. As a result, the de-dollarization of global FX reserves is more likely to benefit developed markets rather than directly strengthen the emerging market FX sphere. Nonetheless, BRICS Plus has inspired many developing countries to adopt similar strategies, using local currencies for cross-border transactions. Calls to reduce dependency on the US dollar are gaining momentum, signaling a growing appetite among emerging economies to take control of their payment systems. This trend challenges US dominance in global trade, with the White House struggling to counteract the shift. Maguire further emphasizes that the dollar's geopolitical weaponization accelerates gold's prominence in global trade. BRICS nations are increasingly using gold to back their currencies, ensuring fair and stable trade benchmarks among economically diverse countries. The de-dollarization process, spearheaded by BRICS Plus, is reshaping the global financial landscape. While the shift toward local currencies may be gradual, the strategic accumulation of gold by central banks signals a long-term move toward an alternative monetary system where gold plays a central role. Before we begin this video, please remember to subscribe to our channel and hit the bell icon so you never miss an update. Also, please share this video with friends and anyone who might benefit from it.
Shane, let's delve into Trump's BRICS tariff threat. Now, while this likely is just posturing to try and come in and bat a strong hand, don't blame him. Let me feed back what really are well-connected global-facing liquidity providers really anticipate. Now, cutting to the quick, further weaponizing the dollar is extremely bullish for gold. Now, here's why. Bottom line, Russia is an energy and agricultural superpower. So existing sanctions already necessitate ongoing settlements that utilize national currencies. So until Trump removes the main sanctions on Russia, it's possible these non-dollar BRICS pay settlements will continue to expand. BRICS is a rising force that has already overtaken the G7, and given the expanded BRICS trading nations either produce or consume 85% of all global commodities, including energy, tariffs will likely backfire on the US more than it impacts the BRICS nations simply dealing amongst themselves. Now, while Trump's BRICS sanction threats may actually temporarily put a hold on formalizing the named launch of a SWIFT-like alternative settlement currency, as far as gold is concerned, it will not halt the ongoing globally driven FX gold price revaluation process. In fact, liquidity providers assess that these threats of further employing the dollar as a geopolitical weapon has already begun to accelerate the usage of the BRICS pay decentralized payment system, enabling BRICS members countries to trade with each other using their own currencies. And as we've previously assessed, I mean, the wide range of national currencies are not equal in value. So when pricing an equitable price to settle a specific trade between nations, it is the percentage of gold that backs that nation's currency which provides the tradable benchmark to price that commodity transaction. In other words, how many grams of gold that nation's FX currency buys so as to value the trade. And that live FX benchmark price then values the commodity trade or currency swap, which can then be hedged. Hence why every BRICS global South facing and Western central bank, alongside billions of dollars of safe haven institutional demand, are all busy converting dollars and US treasuries to gold. This process will not stop. Now, current reports of fresh Chinese central bank buying absolutely, while they're on the news and it's bullish, people are saying, well, look, China's back buying. It pales in comparison to the non-stop continued monetary gold purchases. So in the meantime, every single global central bank except the Fed is accumulating gold. If anything, and I'm not joking, the smart move would be to lean into Basel III compliance and start backing the dollar with gold. It's not such a crazy idea if you're caught naked short using unfunded government liabilities into a global short squeeze. Now, if anyone could force a US Treasury gold price revaluation, it would be Trump. And then what then, after that, what use would the Fed be is the next question. Let's see what Judy Shelton gets up to in January, shall we? Now, the only question remaining, though, is what percentage of your rapidly debasing, depreciating dollars, pounds, euros, yens have you protected with zero counterparty risk, physical gold and silver, guys?
Maguire suggests the silver fix event will establish a price based on physical trades, driving silver toward three-figure valuations. Rising demand from the Shanghai Gold Exchange will weaken bearish multi-billion-dollar derivative structures. Evidence of this bullish momentum is already visible, with silver reaching a near 5-week high of approximately $32.30 during Thursday's European trading session. This strength coincides with market expectations of another Federal Reserve interest rate cut of 25 basis points to 4.25% to 4.5%, announced in Wednesday's policy meeting. Such monetary policy decisions typically favor non-yielding assets like silver by reducing their opportunity costs. The fundamental outlook for silver appears particularly robust, with projections indicating the market will experience its second-largest deficit in 2 decades this year. This shortage is primarily driven by unprecedented industrial demand, which is expected to reach 710.90 million ounces, a 9% increase from the previous year. The solar sector plays a crucial role in this surge, with silver usage in photovoltaic solar panels projected to increase by 20% to 232 million ounces. Maguire also emphasizes the critical nature of current market dynamics, noting that above-ground silver stocks are being steadily depleted amid this growing deficit. According to liquidity providers' assessments, a 3-figure price for silver appears inevitable. Let's get back to the video.
Unlike gold, it's not yet been formally reclassified as a first-tier asset class. But nevertheless, it's a component of Beijing's war efforts alongside hedging, foreshadowed tariffs to come. Liquidity providers assess the relaxing of the SGE rules that we looked at last time is specifically focused on attracting large silver bullion flows into China to meet military and industrial demand. Now, as we outlined in our last episode, by incentivizing millions of smaller investors, that's the millions of SMEs that we looked at on the charts as well, incentivizing them to buy and to trade fully paid for silver, it is greatly impacting global supply, draining underpriced silver already facing a 4-year massive supply deficit. Now, while there is a commodity element to silver, silver is classified as money, which is why, unlike any other commodity, it trades as a foreign exchange cross. So, as I say, long silver, short dollar, yen, etc., or the other way around. Now, with pricing being established in the physical exchanges, where there is always a tradable buy and sell order for every single bar that is actually traded, it's also going to put silver onto the revaluation stair steps. And it's just as when the Bank of International Settlements reclassified gold as a first-tier asset class on the 1st of January 2023. And what they did was force the multi-trillion-dollar FX gold to become NSFR compliant, which meant that liquidity providers all of a sudden had to back each buy and sell order with physical gold. So that was a big change that changed what was really an unallocated market into a physical market. By actually pricing physical silver or physically pricing silver in the FX markets, the silver fix event will produce the same result, which each silver bar will have a real buy and a real sell silver price, and a real silver price will emerge from that fact. It doesn't matter what the price of silver is, there's always going to be a buyer and a seller, but it's not going to be settled in the paper markets. And when we look back at silver in the rear view mirror, when it's trading with a 3-figure handle, yeah, you like that, Shane, it will be realized all the signs to act are really right under our noses now. And at the margin, this fresh SGE demand will be the next catalyst to drive a series of higher physically driven stair steps, this time also revaluing silver. It will begin to bullishly undermine the current bearishly skewed multi-billion-dollar options and OCC structures. We talked about these structures before. These are derivative structures. They're backed by nothing. Now, we've not really evidenced a real balanced supply-demand silver price, really, since it was fractionalized and diluted to be traded on the COMEX about 50 years ago. Now, with silver, with silver supply actually being sucked out of above ground stocks right now into this growing supply deficit, it actually raises the question which we raised last time. What is that price? And while no one exactly knows, every well-connected liquidity provider assesses it has to be a 3-figure price. And once the short squeeze and margin calls hit, it will happen faster than most people realize. This is why every single bullion bank, without exception, is long both gold and silver.
The gold and silver markets are undergoing significant shifts, driven by increasing demand and changes in trading dynamics. Both metals are poised for potential revaluations as physical markets gain more influence. The rising demand, particularly from major players like the Shanghai Gold Exchange, coupled with the transition from paper-based trading to physically backed pricing, is likely to drive prices higher. What do you think the future holds for gold and silver prices? Share your thoughts in the comments below. If you found this analysis valuable, don't forget to like, subscribe, and hit the bell icon for more updates. Thanks for watching.